Show that I have really looked forward to speaking with. Everyone on Twitter is saying, George, you've got to interview this guy. So I reached out to him. Fortunately, we were able to connect. His name is Sahil Bloom. Sahil, welcome to the Rebel Capitalist Show.
Thanks for having me on, George. It's a real pleasure.
Now, you've got a very interesting backstory, and a lot of my viewers may not be up to speed there. So can you fill us in on what you did? I mean, you're an athlete, you're fantastic, and then you kind of got into the world of finance and private equity, and now you're a FinTwit rock star. So kind of walk us through that.
I think you're giving me too much credit, George. I appreciate it, though. I'm going to need to keep you around with me as my hype man.
Yeah, right. I'll be your PR guy.
I'm relatively new to this world, so to speak. So pleased to introduce myself. So grew up on the East Coast, came from an academic family. My father's a professor at Harvard, always academics first. That was always like the mantra my parents had for me. I was kind of the ne'er-do-well son, so to speak. I was like always more interested in sports. I played baseball my whole life growing up. And so academics were not the first thing on my mind. Ended up being fortunate enough to get a scholarship to come out here and play California out at Stanford. So I came out to the West Coast and haven't looked back geographically, at least. But, baseball career had a tremendous experience out here at Stanford. It was an awesome place. Unfortunately, hurt my shoulder. Probably a silver lining to all of that. Just totally candidly, you call me fantastic. I was okay. I had a good college career, but I wasn't going to be, pitching on TV in front of anybody else. My Twitter bio says all you need to know about that. If you go and check it out, I gave up a grand slam on ESPN. So that was maybe my claim to fame, which isn't the best one to have as a baseball player. But so coming out of school, I was fortunate enough to get a job at a private equity fund out here in the Bay Area that was in its early days, joined as an analyst, which is somewhat rare for that world of private equity, which I know, we can get into and talk a little bit more about as we get out here. But now been with the firm about 6 years, helped to run our consumer investing efforts. So sit on the board of a couple of assets in the consumer space, Fox Racing, which is like a motocross mountain biking brand, and then Brixton, which is a clothing streetwear brand, both really cool businesses if you haven't checked them out. And then more recently, why I'm kind of here with you today is, all this stuff with FinTwit, and, the financial Twitter world. And I, kind of came to that all through March, really, when I think, like a lot of your viewers, there was this huge disruption that happened right in the world and in the economy. And so many people were struggling to make sense of everything. You have the economy just tanking, you have the market starting to soar in April and May. And like everyone here, I was trying to figure out what the hell's going on, make sense of it and really be able to make sense of it for other people. I work in the world of finance. So, you get a lot of questions from friends, from family, my former baseball teammates, my mom, my dad, who aren't in this world, just asking questions. And so I thought, what's a way where I can start to make this information digestible, accessible for anybody, not just for people that are finance experts that know all the jargon, but really break it down in a way that people can relate to. And so that's kind of what brings me here today. I've spent a lot of time in that world, and it's been a pleasure getting to know folks like yourself and others, but just excited to chat more about it today.
Okay, very good. So help me understand what you've been doing on Twitter. I know we talked prior to this interview on some of your objectives there, and you mentioned it there with financial education, but kind of who's your demographic and what are you trying to teach them specifically?
Yeah. So I think of it as demystifying the world of finance.
Right.
That's what I keep saying. The way I generally approached it was I looked at the world of FinTwit, and the one thing, and this is the financial world in general, really, is it's an insider's world. Everything that you see from an information standpoint is designed to keep the insiders on the inside and the outsiders on the outside. It's all complex. It's tons of jargon. Everything is overcomplicated, in my opinion, in order to preserve the status quo. And that really, is something that I've always felt was a shame, because all of the concepts are actually not that complicated if you break them down into a way that people can understand. And so my whole goal was, let me make this information accessible through storytelling.
Yeah.
And so what I did was, take these concepts. Well, the Fed put was my first one. Like, why are the markets soaring while the real economy is tanking? What's happening? And I used a story, a simple parable to, make that digestible for anybody. And I test it on my friends, my family, my baseball friends, guys that have no background in finance to make sure, hey, is this getting across to you in a way that you can really understand? And, frankly, I've been blown away by how people have reacted and shared the information. But it shows, clearly people are looking for more understanding of these things. People do want to engage more with the material. And so we need to do a better job as a community, I think, actually, of really arming these people, of educating, rather than just saying, hey, the status quo works, insiders in, outsiders out, let us manage your money for you because you don't know how to do it. I just think that that's a shame, and we should be really focusing more on educating than anything else.
Yeah, and I would go so far as to say a lot of those fund managers really might not know as much as they would lead you to believe, as far as the mechanics of how everything works. And people just blindly, especially like just your average financial advisor. And I don't want to throw anyone under the bus here, and I know there's great ones out there.
Yeah.
But just on aggregate total, I mean, these people aren't going to understand how quantitative easing works, or one of the
well, who
debates.
does, George?
Yeah, well, that's true. I was going to say, one of the debates or back and forth that I've had with Brent and Luke and Lynn is all about, and Steve the Bond King, I got to give him one credit as well. But we've gone back and forth just trying to unpack how the primary dealer banks are actually buying treasuries, and if they're using bank reserves or if they're using cash on their balance sheet, just how that really works, because it's important to understand that to really have a view on if the future is inflationary or deflationary. So you've got these guys and gals here on FinTwit that are experts, that they're proper experts.
Brilliant.
And people are 10 times smarter than I am, and they can't even figure it out. And if they can't figure it out, how do you expect your local person at the Wells Fargo to help advise you on where you should be placing your money? There's zero chance. And I always say, you've got two choices. Either you can be prepared, you can be educated, or you're going to be a victim. And, the way the markets are kind of overinflated right now, to say the least, compared to the economy, I think it's very true in today's day and age. One thing I'd really like to kind of pick your brain on is this kind of V-shaped recovery that we're hearing about. And I think that, we've got a V-shaped recovery in the stock market, but there's no chance we have a V-shaped recovery. I'm not going to say no chance, but almost a 0% chance we have a V-shaped recovery in the actual economy. And you're there boots on the ground because you're a private equity guy. You invest directly in businesses themselves. So you can get an idea of kind of what's happening with them. And obviously, I don't want you to comment on any of the companies you're involved with directly, but just overall. And I know I'm here in Vegas, and I mean, we were talking off camera here that these businesses don't have a 50% margin. They're not software companies, right? They're restaurants, they're hotel casinos that have to take out a lot of debt to build these things. And they're running at, let's say, a 10% margin. Well, if they're only at 50% capacity and they have a 10% margin, that dog won't hunt very long. So anyway, I'd love to get your thoughts on that.
Yeah. No, I'm with you here. And I wish I weren't, but the real economy is a totally different story from the market. You said it best. It's, we had a big deflationary shock in March. I don't think anyone would deny that. And you had the Fed, you had Congress, all of these forces came in to make sure that, it wasn't a 1929 situation of this massive deflationary spiral. And to a great extent, they kind of quote unquote did their job. They plugged a hole as well as they could during that period with all of their actions. But where we sit today, we're still close to 10% unemployment. We can haggle over the numbers and how the calculations are done. But the reality is there are a ton of people that are still unemployed. Mm-hmm. We've been plugging the gaps, though, for this entire period with stimulus checks, with loan forgiveness, basically making sure that the actual impact of that unemployment is delayed as far out as possible. And, whether it's political or whether it's, just an economic thing that Congress and the Fed are pushing towards, it's had the impact that you're basically just delaying the inevitable. In my view, you still have a massive group of people that are unemployed. And at some point, the chickens come to roost, unfortunately. We can't just give all these people jobs back, because a lot of these companies, to your point, you mentioned the restaurants, hospitality industry, hotels, airlines, a lot of those jobs are not coming back right away. Maybe eventually 4 or 5 years down the road, I don't think the airlines ever come back to the level they were at. I think there are going to be swaths of the economy that never recover because they were, not meant to be in 10 or 15 years. And this turned into an accelerating event towards that. So what do you do in an environment of 8, 9, 10% unemployment, in perpetuity? That's no longer a viable real economy. And so is the Fed, is Congress going to, in perpetuity, be able to support this? I don't know. Congress has shown in the last week and a half that they're unwilling to keep things going. And I think part of that, if you ask me, is because the market is doing so well, you lose this, excitement and
urgency factor.
Yeah, exactly. I mean, you have an environment where, the physical manifestation of the economy for most people is the stock market. And you have a president who talks a lot about that. So for most people, when they look, they say, oh, the economy is doing well because the stock market has boomed to all-time highs where it is today. But the reality is, hundreds of thousands, millions of people are still really suffering and will continue to suffer if we don't do more or figure out a way to get those people back to work, whether it's infrastructure spending or something that just gets people back to where they're making income.
Yeah, we're dealing with an insolvency issue, and we're not necessarily dealing with a liquidity issue anymore.
Yeah, you can't fix it.
Completely different dynamics. What's interesting is I had to take an Uber this morning. And actually, I had to take one Saturday night as well when I was meeting with a good buddy of mine, Robert Barnes. And I found it very odd Saturday night. It was, let's say, 11 o'clock down on the strip. We're at Palazzo, and there were no Ubers available. Like you pull up the app and it says no cars available. Like I'd never even really seen that. And I'm like, okay. So we had to wait for about 30 minutes. And then I had to end up taking like an Excel Uber because that was the only one. I didn't really think anything of it until this morning, and today's Monday. I went to get another Uber to go over to my mom's place, and sure enough, same thing. No Ubers available. I'm like, what is going on here? And this was maybe 8, 9 o'clock this morning. And so again, I had to use, you go to the comfort one, no cars available. XL, finally you get one that's like 15 minutes away. So I got this guy to show up, and he had been driving Uber full time for like 3 or 4 years. So he's like, he gets it. And I'm like, what's going on? I don't understand why there's so few Uber drivers. And he goes, because, and both he and his wife have driven Uber for like 3 years, almost full time. And he's like, because a lot of the Uber drivers here, they lost their car. They couldn't afford to make the payments. Wow. And therefore there's no more Uber drivers. And wow. I mean, as soon as he said that, I'm like, okay, this is ugly. This is exactly.
Yeah. I mean, you learn so much about the real economy by having conversations like that. You learn more by doing that than by reading any textbook, by going to any class, by reading any Bloomberg, CNBC news article. You learn more by having that conversation, which is really, I mean, it's scary.
Yeah. And this gentleman was talking about how much money he was getting with his unemployment checks or stimulus or whatever. Obviously, he had no idea who I was, and I was just kind of nodding my head.
Taking notes.
Yeah, but he was saying that he hadn't been working in 3 months because he was getting paid $1,100 a week.
Yeah.
$1,100 a week, so $4,400 a month, call it, just to stay home. And he's like, why would I drive Uber? It's going to cost me $500. There's no tourists here. I'm going to spend more money in gas. So he's just at home, just kind of saving as much money as he can until he.
Yeah. Depending on what part of the country you were in, you saw it a lot in warehouse workers, industrial and warehouse workers, where you're making a lot more money being unemployed than you were going back to work. And so the companies, as they saw demand recover, stimulus checks went out, demand started to recover. You actually were having trouble finding people to come back in and work in the warehouses because those people were making more money sitting around. And so, why would you come back to work, put yourself at risk, whatever it might be? It was a classic example to me of like the government, just not thinking things through in terms of the implementation of something. They're great at coming up with ideas and very, very bad at coming up with, ideas that don't have those kind of kinks in them. The implementation is often lacking. So that was a great example of that.
Yes, those unintended consequences.
Yeah.
So what's great about your position is you really know the inside and out of real businesses. So many people I talk to are in finance, or they're macro guys and gals, and they might not have ever been in the thick of things, of the business with 1,000 employees or 100 employees, something like that. I have been there on the other side as an entrepreneur, and I've started businesses from scratch. Never got huge. The biggest business I had about 100 employees. But you really see that. So I'd love to hear your opinion on how the business works if they're having to compete or with the government for employees, and the government is currently willing to pay those employees more to stay home than the employer can afford to pay them to come into work. And then what does that happen with the amount of supply of goods and services, and what are businesses doing to combat that? I mean, what's their game plan?
Yeah, no, it's a great question. And, you're right. My experience is tied to real companies in that way. We are, a very operationally focused firm. We're not the financial engineers you read about in books and the horror stories of private equity. I just want to make that clear at the outset. We're not levering things up to the hilt in that way. We're really, we come at things from a fundamental business value creation standpoint.
Yeah. So everyone watching right now, just unclick that dislike button.
Yeah, please. No, I know there have been bad actors in the space. I'm very cognizant of it, and don't want to be viewed that way. But no, it's been a real struggle. I think a lot of the companies I've seen have dealt with it in a few different ways. They've definitely seen it. First off, the issue in warehouses has been big because you have, workers that are working in that hourly range where you were making more money by going on unemployment during the period, and with the enhanced unemployment benefits and everything that was coming with it. One of the ways was with hero pay. You saw a lot of that where companies were paying kind of an increased rate, almost like a time and a half type rate during the period, in order to manage the fact that there was this disincentive to come back to work. So you were paying above average rates in order to get people over and above what the government was willing to pay. But you had a cash flow issue with that. So you were asking people, to come back, and then you were having to manage against cash flows. And so what it led to in a lot of cases was additional furloughs in other, non kind of core day-to-day essential areas, because you had to manage, you had to manage the cash flows with all of it. So it was this give and take where you knew, in the warehouse, you needed people because that's your revenue. Shipping things out the door, in and out, was your revenue. And so you need those people. And if you have to pay them more, you have to figure out how to get rid of people that are, further, 12, 18, 24 month revenue people that are generating things further out. Which is a shame, because if you think about the impact of that long term, right, you have people that are, surrounding investing in the business for the long term and thinking about the long term growth of the business versus the here and now, in the warehouse. And when you're having to make that trade in a real context in real time, it does have long term ramifications for how businesses were able to invest, reinvest, et cetera.
Did they have any pricing power? Because that's what's coming to mind is if I'm a business owner, I'm thinking, okay, I can either let go of some of my staff, or maybe I can increase my prices to try to generate some more revenue. But if my demand is falling off a cliff, that's definitely not an option.
Yeah. The demand falling off a cliff was the one that shocked me the most. And this gets back to this idea of the fake economy that is floating around right now. We saw demand surge, starting from when stimulus checks went out. there's just been this general feeling, particularly on the e-commerce side of the business world, if you're in the consumer world, where demand really took off. We saw it kind of surge back after a really bad deep hole in March. We saw it start to come back in April and then really just go crazy to points where you were actually generating more revenue than you were in the prior year, which is really crazy to think that, year over year in an environment where I'm saving money. I'm trying not to spend any money because I'm thinking about, man, we could be in for a long slog. I want to be saving for a rainy day. But the general economic sentiment is clearly positive. I mean, consumer sentiment going into this crash was quite positive. And I think with what the government did, with what the Fed did, you had the government put, I think Lynn Alden called it on one of your interviews with her last week. And it worked to a great extent. I think people assumed there was going to be this fiscal put in the market that was going to continue to stabilize things in perpetuity. And that now we're seeing maybe that wasn't so right, with Congress's inability to keep things going. So I think the most interesting learnings are going to come in the next 6 months. As you have this election buzz kind of roll off, as you have the reality of whatever we're in actually setting in.
Okay, so you're thinking that it was kind of a combination of people getting more money than they were making at work by staying home, so their incomes actually increase, which is, Lynn has talked about that as well, combined with the fact that they saw all of this stimulus from the government, and the government saying that they're going to do whatever it takes along with the Fed, and therefore they got maybe a little overconfident about the future. Yeah. They're willing to go out and spend those stimulus checks, and then that's what created the additional demand in the businesses that you see, or that you do.
I think the other piece is people have, there's an optimism bias. People assume these jobs are all coming back. Right. That's been the rhetoric from the get-go, from the political side of things. And I think people believe it. The general consensus is you have this shock. We had to shut down the economy. Hindsight's 2020, whether we should have or not, but we did. A lot of people lost their jobs because of that, but it's temporary. And so the consensus is you flip the switch, the whole economy has a light switch idea. You flip the switch, everyone comes back. Oh, come back to work. Everything's fine. And the reality is quite different from that, unfortunately. As you think about a lot of companies in the economy that I've seen, you made furloughs, you made cuts because you had to survive the dark period. You didn't know how long it was going to last. You had to manage cash flows very conservatively. Well, now I think of it as like a runner training at altitude. You go and you train at altitude to make your lungs more efficient. They become more efficient, and now you come back down to normal, to sea level, and you no longer need that same amount of air as what you did because you're more efficient. And it's the same thing for companies. A lot of companies have figured out, they made these cuts, they made the furloughs, and they've realized they can actually operate more efficiently than they previously did. Like that they don't need to bring back all of those people that they previously had. And it's great for businesses as you think about their operating margins, because they will now, as revenue recovers, operate at higher margins. But there's a long lasting kind of cycle effect to it where now you have higher operating margins, but there's a higher unemployment rate in the country because these people aren't coming back. So does demand slowly have this, roll off effect where you start seeing revenues impacted because all of those jobs are not coming back. The economy, you cannot flip a light switch and just bring all these jobs back. And so I think that the optimism around that has been misguided to a certain extent. And it's upsetting because I think, there's going to be a rude awakening versus where people think we're going to be in 3 to 6 months.
Yeah, it takes me back to a conversation I had with Jim Bianco, and he had done a lot of research on it. And he said, George, what people don't understand is if we go back to the GFC, 2008, 2009, we all know how bad that was, but that was economic output going down by 6%.
Yeah.
So economic output goes from 100% down to 94%. That gives us the GFC. Because if you take economic output from 100% down to 75%, just down by 25%, that takes us to the Great Depression. So back then when I talked to him, a lot of people were saying, well, we'll probably have some type of recovery. Hopefully we can get back up to 75% of economic output. But to his point, he was saying, okay, well, that's not good because that just takes us right back to the Great Depression. And
Yeah.
I think that that's something that most people, I don't think, are really
Yeah.
through.
Yeah, he's extremely, extremely sharp, and he's absolutely right. To me, it's been an entire kind of anchoring bias. It's like a case study in the anchoring behavioral bias, where we all got anchored off such a horrific set of data points in March and April that
Mm.
everything felt like this astronomical
Oh,
booming
right,
recovery,
right.
and so you get tied to these terrible numbers, and now any number we see, it's like, we're going to print the next quarterly EBITDA, or sorry, I'm talking in private equity terms, the next quarterly GDP number, and it's going to be great. You're going to have a quarter over quarter boom versus where you were by nature of the fact that you were in such a horrible position. And so, to me, it's all about anchoring, and I think about things in real, absolute terms. And if where you're landing is on a relative basis great compared to the horrible point, that's not so good if it's still on an absolute basis terrible.
Right.
And so I continue to be bearish on the real economy. The stock market, anybody's guess is as good as mine, but with the Fed put in the markets, everyone last week or 2 weeks ago was talking about the big drop in the NASDAQ, and is this the turn of the markets? I just don't see a reason for a huge reset in the market. I think the general assumption is if there's a big drop, the Fed starts buying equities and it'll pick back up. And so if that's going to happen, what's the actual narrative behind the drop then? Why would it happen? So I continue to be bearish on the real economy, but I want to see how the next 3 to 6 months play out from an economic output standpoint before I make any, final claims on it.
Yeah, very well said. So you and I have spoken about the 401k, we'll call
Yeah.
it issue, and so many of my viewers and commenters always say, listen, George, I've got we'll call it a normal kind of 9 to 5 gig, and my employer matches what I put into the 401k to a certain percentage or a certain dollar amount. And it's just kind of a no-brainer. I have to put money into this 401k because there's such a high dollar amount as far as that employer match. But by putting it into this 401k, I'm very limited by what I can actually invest in. And I've heard some people say that sometimes they're only given like 4 or 5 choices, as it's like this index fund, that index fund, or this one. And it's just A, B, or C, take your pick. And they come to me and say, well, if you're very very bearish on the economy, and all of these funds are tied to the economy, it's kind of like this cost benefit analysis, where do you not put the money into the 401k because what the 401k, the options there aren't very good, but then you don't get that employer match.
Mm-hmm.
It's kind of this balancing act. So I'd love to get your thoughts on the 401k thing, what the problems are, and maybe some potential solutions.
Yeah. I think it's a huge problem. You're absolutely right. I mean, it's just another example to me of all of our economic institutions, all kind of surrounding the incumbent system, right? It's all designed to benefit the insiders. It's all designed to benefit the current infrastructure and the current systems that we have in place. And that's, these 401k providers, that's the traditional equity instruments that they're investing into, these mutual funds that oftentimes have higher fees than they should. It's a system that doesn't work for the current era, in my opinion, and yet it continues to be the incumbent system. And the people that benefit from it most are the ones that design the systems, right? And so they have no incentive to change it. I just think about it of like, if I were to tell my parents are kind of nearing retirement age, what should you be doing with your money? For them, I would never say, put 100% of it into, some kind of 60-40 fund, right? Like risk parity. It just doesn't make sense in the modern day and age of what we're facing. I look at things and I say, should you have an allocation to precious metals? Should you have an allocation to Bitcoin? Should you have an allocation to all these different things? Well, what is the way for people to do that? To your point, you have this employer match, which effectively is, kind of a golden handcuffs to the current system, right?
Yeah,
it's free,
right.
It's free money. And so how can you turn that down in order to opt out of the system for something else? It's very difficult. And so, I see these new companies that are coming out trying to kind of chip away at the current system. A friend of mine, Scott Melker, is kind of supporting this company called Choice IRA, which allows you to more self-design an allocation around an IRA. It allows you to include cryptocurrencies or Bitcoin. It allows you to do different things. And so I think there are going to be people that are trying to solve this system, but until you have large companies giving you the ability to opt out of these incumbent 401k systems and into something else that they will support that has more flexibility and has the ability to self-set allocations, it's going to be very hard to do it, just because of that golden handcuff that ties you to it.
Do you know why they're set up that way? Like why is it that an employer will only do an employer match if you just go into these three funds? Like why don't they give you that liberty?
I don't know. I don't know today. It'd be an interesting question for your audience, because I'm sure,
maybe they can
with the
let us
size
know
of
in
the
the
audience,
comments.
someone should chime in the comments. I'm sure if I know the way our current systems work, I'm sure there's something nefarious if you go back far enough of
Yeah, right.
someone who benefited from it, and what there were kickbacks or something. I hate to say that, but I'm sure there is.
Right.
Because you would think, just rational mindset. I think you will see more and more companies opting for something different. But current companies, that's the status quo. It's okay. You can opt into this 100% equity. You can opt into this 60-40, equity bond split, or you can opt into whatever it might be. And they'll match you up to 3%. And so you take your free money and you're happy with it until you learn that maybe it's not the best thing in the world that you should be doing right now.
Yeah, exactly.
And you see the numbers. I mean, it's striking. If you, I'm sure wealth advisors are looking at this too. If you do really poorly in the years leading up to retirement, you will be in a bad position. As you try to live off that nest egg for the rest of your life. And with retirement age being what it is, but with life expectancy having extended, it's a challenging issue. I mean, this entitlement issue, alongside all of it in the U.S. and the aging population demographics. I mean, my dad's a demographer by trade. And so I've grown up around that, and seeing him talk about the issues facing Japan, with its crazy aging population, and now that coming to the United States, it's a really scary issue, and one that, frankly, I don't think enough people are talking about.
Man, it's such a great point. And also on Japan, I'm thinking about their stock market peaks out in 90 and has gone just down, down, down. I'm not sure where it is now, but let's say it's 50% lower in nominal terms.
Yeah.
It was back in 90. I think the European market peaked out in 2000 and hasn't got back to those levels in nominal terms. And so I'm just, I always kind of think that we've got so many people that have so much of their future purchasing power tied up in the stock market. What if the U.S. follows their lead? I mean, we like to think that the United States is exceptional, but I don't know that we are in terms of the stock market. And the Japanese central bank came in and tried to buy ETFs and tried to prop up their market. That didn't work. So, I mean, what would happen if we get a 15-year run where in, call it 2035, the stock market or the S&P is at a lower level in nominal terms than it is today?
Yeah, it's a really scary dynamic. And what you're hitting on is something I've looked at a lot, because it's also with the backdrop of a risk-free rate of essentially zero or approaching zero in those markets. In Japan, it's kind of steadily declined to zero. It's been at or below on a real basis. I think a large part of that was a lot of the money flowed out of Japan and went and propped up the U.S. markets, right? I'm sure there's a similar dynamic in Europe, where you had the globalization of the financial markets, and so money ran out of those economies and dove into the U.S. market, and so you have this continuously rising U.S. market over that same period. But it's an interesting dynamic. I don't know. I don't know what we expect we can see over the coming years. I do expect the continued deterioration of the dollar, and I don't know on a relative basis if that means the destruction of the dollar, I see all the arguments and the dollar milkshake theory, my friend Brent,
Yeah.
and all these other folks. And I continue to think, the dollar's reserve status is not in jeopardy today. I just, there's too much of the economy that's still tied to too much of the global economy that's still tied to the US dollar. I think I saw a stat that like 60+% of the world now is, kind of anchored around or uses the dollar versus something like, I don't know, 20-ish% back when Bretton Woods was signed. And so it's, it's a world economy that is still so anchored around the dollar that I don't see our reserve status changing. But when you look at the S&P 500 measured in gold, over the last 20, 30 years, it's a much more, striking picture than what you see if you look at it on dollar terms.
Yeah, that's for sure. So I would really kick myself if I had a private equity guy on the Rebel Capitalist show and didn't take a deep dive into that industry, because we don't really get to talk to people that are kind of that understand the inside, or have an insider's views to how that works. So let's just start by doing an overview as how private equity works. Yeah. And kind of what you do, what you guys look for. And then I'd love to get into who can take advantage of these investments. Is it just accredited, or is it retail, or just kind of go over all that?
Yeah, no, absolutely. So, just to give a broad overview, the way I think about private equity, first off, remove your kind of Pretty Woman movie misconceptions around private equity and anything you might understand. So the basic idea I think of is like, I use the example of a house. Yep. Like you're going to invest in a house, and you want to go find a house where you think you can make a good return on that investment. So you don't find maybe the perfect house on the perfect street that's brand new and newly built. You kind of want to find a house that has some things you can improve about it. It has great bones, good structure. It's in a good neighborhood, but maybe the grass is a little grown out. Maybe there's a shingle or two falling off. It needs a new coat of paint, something like that. And so you look at it and you say, oh, I can affect some change here and make it better than it was. And so when you go to buy that house, you don't buy it with all cash. You get a mortgage, right? So you put down some cash, maybe 25, 30, 40%, and the rest you take out as debt. And that's no different from us. When we go to buy a company, we use usually nowadays 40 or 50, for us 50%. In cash equity, and the rest is debt from a bank or some financial institution. You use that and you make an investment, you acquire the asset. So you've now invested, you're the proud owner of this new home. Well, now you go about actually making those changes that you envisioned, the things you hypothesized would make the house more valuable. And so you go and you improve, you do the coat of paint, you mow the lawn, you fix the shingles, whatever it might be. A few years later, hopefully the neighborhood has appreciated in value and your house is much nicer. And so you go and you sell the house for more than you bought it for, and you make a good return. The debt, as people probably understand, amplifies that return because you didn't have to pay the full price at the outset. And it's the same thing with us, with the company. That whole process plays out. So when we go look at a company, we look and say, can this company grow? Can it grow its earnings from where it is today? We look at earnings. Some private equity funds that are earlier stage would look at revenues. We tend to focus on cash flow and earnings. And so we look and say, are there opportunities for the revenue base of this company to grow? Are there opportunity for margins to grow, from fixed cost leverage, from continuing to expand upon its current fixed cost base? And then we affect those changes. So we get involved at the board level. We might get involved in kind of strategic projects on the ground. When I first joined the firm that I'm currently at, I was working on a kind of product rationalization project. Realized that basically that 80% of the design spend at this consumer company was basically being wasted on products that were only generating about 5 or 10% of the gross profit of the company. So going and looking at things like that in the data to figure out how can you optimize this company, how can you optimize the earnings of it and make it better than it currently is. And then you go sell the business onto a new investor, onto a strategic investor, a public company, onto another private equity fund. You can take it public. There's kind of a variety of options for those type of things, but you realize the returns of your investment. And then from a business model standpoint, we're investing on behalf of large institutions and high net worth individuals usually. So with a fund, you might have endowments like a Harvard or a Stanford endowment. You might have pension funds with some of the bigger private equity funds. You can have sovereign wealth funds. So, some of the large European or Middle Eastern sovereign wealth funds are investors in private equity. And you're trying to provide a return to those investors. The business model for the private equity fund is that you're taking kind of a percent of those profits is the vast majority of what you make. So when you hear about, the carried interest, the tax loophole that everybody wants to close, that's kind of what they're talking about. It's carried interest is just the percent of the profits that you're taking.
Yeah, but the key takeaway, guys, that I really want you to focus on for the viewers and the listeners is that Sahil and his team they're going in there and they're focusing on earnings. They're focusing on profit. They're focusing on increasing sales. They're focusing on improving management, on improving marketing. They're not going in there and asking themselves, the very first question is, do we think the price of this business is going up? They're trying to force the price of the business to go up by making sure that it makes more money.
Yep.
And makes more profit. And so many people right now, they look at stocks in the stock market, and the very first question they ask themselves is the price of this stock going to go up? And they completely ignore all of the fundamentals. They ignore the fact that business should do well or poorly based on how much money and profit they're actually making. And if they would just adjust their framework to focus on what they would focus if they actually went out there and bought the business, I think they do so much better. And I love your example about real estate. And when I do real estate, especially in South America, mm-hmm. I never, ever, ever worry about the market going up or down. Never. All I worry about, if the market goes up, great, but I don't even think about it.
You can't control it.
The only thing I worry about is buying an undervalued asset, improving the asset, enforcing the appreciation or the equity. And you're doing everything you can in education. How can we educate people to think that way?
Yeah, no, it's a great question. I mean, it's a classic speculative bubble, right? It's like one of the signs of a bubble. You see, like Ray Dalio has the great 7 signs of a bubble work that he's done in the past. And one of them is that you're speculating on continued price increases. You're buying it because you believe the price will be higher tomorrow, rather than buying it because you think it's fundamentally undervalued. And it's why I'm so, when I think about things, I think about them in terms of the real economy, because so much of what I do is actually tied to the real economy. We can't possibly hope for there to be a, massive speculative bubble around middle market businesses that we're going and buying, because they're not liquid. It's, I can't just go sell one of these businesses tomorrow because there's someone that's willing to all of a sudden pay you a ton for it. It's a totally illiquid asset class, and it requires you really thinking for the long term. It requires you thinking for 3, 5, 7, 10 years. It's not a quick flip thing where you can buy Tesla stock today hoping that it's worth 2x that in a day and a half.
S&P 500 or something, right?
Yeah, exactly. I mean, it's a totally different ballgame, and it's what you need to focus on. I come back to, look, it's all to me about, I hate to say value investing because it's gotten a really bad rep, with growth versus value stocks and all of that. But what it really means to me is just you're focusing on the fundamentals, you're focusing on the asset, and buying an asset at what you believe is, a discount to its intrinsic value. And why wouldn't you want to do that? Whether it's real estate, whether it's a company, and it's all about then, beyond that, it's how can you actually affect the improvement in the value of this company? You can't impact the market. I can't impact, if you're investing in South American real estate, I can't impact the market in the South American country where I am, but I can impact whether the house has fundamentals that are strong. I can impact the foundation. I can impact the roof. I can impact those type of things. And so why not focus on that? You feel a lot more in control of it, right? And to me, it's all about when you're investing, you want to have things that you can control that will deliver value in the long term. When you're investing and speculating, to buy something because you think the price will increase the next day, you have zero control over that. It's just as likely to go down. Maybe not right now because things are crazy, but eventually it's just as likely to go down as it is to go up. I mean, it's like Isaac Newton is a genius, but he fell victim to the South Sea bubble. And lost most of his fortune in that. So you can be the smartest person in the world, or you can, be the dumbest person in the world, and you can fall victim to these type of things. So I find that the best way to avoid it is just focus on things you can actually control and invest in areas where you feel like you can drive value through that.
Yeah, and you got an edge, and it's just people just have to remember that the reason a stock should go up is because the company is making more money. That's the reason a stock should go up. It shouldn't go up because of a Fed put or additional liquidity or government stimulus checks or quantitative easing, or it should go up because the business is actually improving. I know it's shocking to hear that.
It's shocking. And when you look at things like Tesla, it's crazy, right? I mean, from January to today, it was like almost up 5x. I don't know where it is today. It jumps around so much, but the idea that company, has 5x'd in terms of its future, the discounted present, the present value of the future cash flows are worth 5x. It's like, it's insanity. It's ludicrous. If you put it in normal terms like that. So I agree. I think, it's hard. It comes down to when the music's playing and everyone else is dancing, it's very hard not to dance. But long term, if you were to kind of go look at people that have been successful over 20, 30, 40 years and accrued massive wealth and taken care of their families and done all of the things that you and I and all of the listeners want to do, the way they do it is by staying the course and focusing on fundamentals. It's not by going and jumping after, every time the music is playing and going and dancing for, as short of a period as possible and hoping that you can get out before everyone stops and the music stops. It's really by focusing on fundamentals. And it's by accruing and compounding for the long term. It's by thinking long term and taking your swings when you feel like you have an asymmetric, upside chance with something.
Yeah, that's right. I always use the example of a McDonald's. I just tell people, just pretend you're buying a McDonald's.
Yeah.
You'd never buy a McDonald's and say, well, I wonder if I can sell it to someone tomorrow at a higher price. Going back to your point, you're just looking at the P&L, you're looking at the balance sheet, and you're just determining, how much money am I going to make? What's my ROI, and how can I improve the business through economies of scale? And
it's funny you mentioned McDonald's, because our best investment we've made is in the largest franchisee of Taco Bells in the world, and they are just incredible businesses, and we will never sell that if we don't have to. I mean, the cash on cash returns those things spit out are just insane. And it's just a great business model, but you didn't buy that thinking you would sell that the next day to someone else, right? You bought it because you thought you could drive good margins and drive a good cash flow return out of each individual Taco Bell. Right. And in the aggregate, it comes together and you buy more and you build more of them over time. And it's an incredible business.
Yeah, that's right. With profits, not with
real cash profits. Funny how that works.
Yeah, exactly. All right. So what's your take on the pension funds? And I'm thinking of CalPERS specifically getting into private equity, I've just read this here and there that, typically they just go into like treasuries and try to get that 7% return that's required for them to meet their obligations. Obviously, they haven't been able to meet that 7%, so they're getting more and more underfunded. So therefore, they're going further and further out the risk curve. Yeah. And if I'm not mistaken, they're going so far as to going into private equity, which might not fit their risk profile, or does it? Or what's your opinion on that?
Yeah, it's a challenging issue that a lot of them are facing. Risk-free rate is zero, right? So they still need, in order to hit their models, in order to have, and fulfill these obligations, they need to generate that return. And so they are going and going out the risk curve. Private equity has always been, from what I understand, a small piece of their allocation. But as you say, if you're going to hit that 8% and now you have an allocation that needs to shift, you need to shift towards more quote unquote risky asset classes. I generally like to think that those groups will do well if they are selective in who they choose. The kind of top quartile performers in the private equity space will generate you 15, 20+%, kind of net IRRs. And so if you're doing well investing in the right funds, that's a great outcome for you. The problem is, in the past, if groups like that have gone too wide in terms of how they've dispersed their money that was towards the private equity allocation, you can really dilute that return, because after the top quartile of funds, there's a huge fall off. And, the way private equity works or hedge funds work, you probably see a lot of the news on hedge funds and how few of them actually really outperform the market. It's a distribution. And what you have is a cyclical market where when you're in a bull market, everyone's able to go raise money. And so hedge funds in particular, tons of money is raised during bull markets because everyone's smart and everyone can outperform the market and says they can. And then a lot of them don't do well when the first bear market comes around, and a lot of them go out of business. And so now you're kind of left with the guys that are doing well. And so I think what you have is, an environment where pension funds are trying to find A, the right performers, or B, decide to go direct. And some of the Canadian pension funds have done well with going and doing direct private equity deals to avoid the fees and kind of the cuts that they end up having to give up to the funds that they go through. That's a much more challenging thing because you have to hire, right? You have to go out and hire people to do that and staff it, rather than doing diligence on a private equity fund that you're going to invest through. You have to go hire a team to do diligence on individual deals. And that's a much more different thing. And it's a really resource intensive model. We have a whole team built out to do those kind of things. So it's a tricky spot. A lot of the pension funds, it goes back to all of this stuff we were talking about around entitlements and pension, the pension crisis that's ahead of us. But it's, in an environment of zero risk-free rates, it's very challenging for them to meet their models and make it work in the long run.
What do you think of SoftBank?
I think that they've kind of perpetuated and created one of the greatest asset bubbles of our generation. I've seen it in Silicon Valley for the last 2 years with the Vision Fund and everything they've done. I think, they created like a SoftBank put in the market, right? They went and threw hundreds of millions of dollars at, multiple companies in the same industry, and basically encouraged people to go spend with, no intention of making profits, just to go win these kind of winner take all markets that they perceived. And it was globally. Kind of a strange strategy. Maybe it works out, and hopefully some of those companies they funded will go on to become world-changing companies. And then you'll say, hey, it was good that they had deployed that capital. But, it's been bizarre. And I think they created this massive kind of private market asset price inflation that a lot of the venture capital funds bemoan by doing that. And now, you start hearing about them buying a ton of NASDAQ, calls in the public markets, and they're doing it again here. So go figure.
Yeah, it's amazing. It's really just, it seems like there's no price discovery in anything anymore because it's all so manipulated and twisted and kind of.
Well, how do you model it? I always come back when I'm looking at models. I always come back to cash flows. We're talking about that. It's like it's all about earnings, profits, cash flows. How do you model something that's like losing money in perpetuity out to it has no plan on a unit economic basis to make any money? It's like it's just really difficult. I don't know what you make assumptions around or how you plan on what the exit looks like.
What I always try to think through in my own mind, just to keep it simple, is I tell people I just like to focus on businesses where I'm buying $1 for 50 cents instead of a business where you're buying $1 for $3, hoping to sell it for $5, or in this case, you're buying $0 for $3.
Yeah, it's really true. I always, I always come back to unit economics. The first thing I do when I go look at a new business is try to figure out in very simple terms, how does this business work? Like at one customer, one purchase, how does this business work? And does it make sense? Does the unit economic model make sense? And with so many of these businesses, it just doesn't make sense. They're losing money on the actual purchase. And so if you're losing money on the purchase and you have, unless you're planning to dramatically scale the price that you're charging, or unless you have some way where once you knock people out of the market, you're going to be able to drive better margins or something. I just don't understand how you can make a business model work when, you know, your first purchase profit negative.
Yeah, right. Exactly. So is there a way for the retail investor to get into private equity, or is it just all accredited?
It's pretty high barriers to entry today, unfortunately.
Yeah.
I think it's going to change. You know, I've been talking about this with a bunch of friends recently of like, how do, you know, mom and pop investors get access to these type of asset classes? Because traditionally, it is a potential high return asset class in the same way that, you know, real estate and some of these other areas have been democratized by these new platforms that exist, for better or for worse in some cases. Private equity is an industry that's, I think, in need of having that type of thing happen. You know, you've seen it happen at the earlier stage of private equity, kind of the venture and growth world. There's things like Seed Invest is a company that came out that allows you to invest in kind of seed or early stage companies. Equity Zen is another one that kind of allows you to invest in like pre-IPO technology and VC companies. So there's some it's starting to happen. I think they're all still accredited investors only, but I'm sure that's going to change. I mean, the accreditation laws are one of the biggest travesties to me that that exist in modern financial regulation. I mean, like the fact that I am, you know, I have to be an accredited investor to invest in my friend's startup, but I can go on Robinhood and buy a XXX levered mortgage ETN, you know, at will. Like my 16-year-old can go do that. I mean, it's unbelievable. So I think that's got to change. Those barriers have to get broken down. And this will change. I would guess in the next 5 years, there'll be someone that's doing, you know, more access for private equity investments.
And whenever I hear about disruption, it's always about how the average investor can buy some tech company or some tech startup. Or what I'd like to do is I'd like to see a way for the average investor to invest directly into the purchase of a Taco Bell.
Totally.
Or something like that. That is just a great business. It's run off a ton of cash, or maybe 5 Taco Bells, or, you know, from a franchisee or something, or Kentucky Fried Chicken, or, you know, something like that. And maybe both. I think that would be.
Yeah. Maybe
really
you're onto something. I mean, you know, I do think the idea of, like, people have done search funds in the past where they'll go raise a bit of money to go deploy, you know, into small assets like that and do, you know, a small group of franchisees or something like that, Taco Bell's, McDonald's, et cetera. And, you know, I think you could see a way where you could carve out a sliver of that allocation and chop it up so that people could come in and invest in that. I would love to be invested in those type of things, right? I mean, it's a great asset class and one that's much more tied to real fundamentals and real cash flows.
Exactly. All right. I know we've gone probably over an hour here, so we'll go ahead and wrap it up. It's been just a fascinating conversation. I really enjoyed this, and we'll definitely have to do it again soon. For my viewers and listeners who want to find out more about what you do, where can they go?
Yeah, you can follow me on Twitter at Sahil Bloom. It's just my name. And then I've got a website as well where I store all of my threads so that they're easier to find. And that's just www.sahilbloom.com.
Awesome, buddy. I appreciate it. We'll do it again real soon.
Thanks so much, George. I appreciate it too.